Hi, Phil. Thank you so much for accepting the interview. It's always nice to see you.
It's great to catch up again.
Of course. So the first question is always going to be about the Federal Reserve. The Federal Reserve just cut rates by 25 BPS. Do you think this mainly addressed to labor market weakness or inflation progress, or due to financial stability concerns?
I think really the mood shift when we saw the labor market data soften. And it's really been softening for a number of years, but then there was a revision to the data as well, which took out 1 million people we thought had got jobs that didn't. So the unemployment rate's been starting to tick up. When you see less and less new jobs, it's a sign that the economy is softening. And I think in reality, inflation has been under 3% for a long time. So even though it's ticking up a little bit, it's pretty close to the 2% target. It's way below the 7 or 8% level that we used to have. And so inflation really isn't the concern that they should have worried about. I think they were worried because the tariffs had the potential to come through and increase inflation by 2-3 percentage points in a short period of time. And we just haven't seen that.
So with one rate cut delivered as market expected already, how should investors think about the pace and magnitude of future easing? Do you think the Federal Reserve is leaning toward a series of cuts or a more cautious one-and-wait stance?
You look at the dot plots, it does look like they're going to be doing 2, maybe 3 this year, maybe another 2 the year after. That kind of gets us close to a 3.5% interest rate, which if you look at Europe and you look at other countries in the world that didn't pause like we did because of the tariff war, kind of gets us back in line with those countries. And to sort of think about where interest rates should be, we just talked about how inflation's pretty close to neutral and unemployment's kind of pretty decent but softening. So we're almost in a neutral economy, right? It's not too hot, not too cold. We have, if inflation's at 2 to 3.5%, we probably have a slow demographic expansion. So we really don't need interest rates much more than another % above that. So 3.5 is probably about where we should target. If we start to talk about something below that, we might be talking about recessions.
Okay, so with this expectation, well, how do you think about the US economy's outlook in the next 6 to 12 months?
What's interesting is we were talking about recessions years ago.
Right.
No one's talking about recessions now. So even though we just talked about everything softening, sort of cooling, it's not going into reverse. We haven't seen layoffs. I think that's important. Because of that, the consumer is still spending, and now rates are coming down. A lot of companies should have less interest expense. That should kind of help them grow profits. There's a lot of reasons to think, especially with the fiscal stimulus that got passed with this administration and lower regulations kind of in the pipeline, we should actually be okay to keep growing, but at a slower rate than maybe we were used to 2 or 3 years ago.
So what kind of spillover effects do you expect this rate cut would bring to other global markets, especially in emerging markets and dollar exchange rate?
Yeah, the stock market's almost different to the economy, actually. If you look at the growth of a lot of the stocks in the stock market recently, it's really been driven by earnings, and the earnings that we're seeing are AI spend. And so all of the companies making chips, building chip fabs, doing the GPT, LLM model factoring are the companies that are earning a lot of revenues and growing their revenues and growing their stock price. So actually what's driving the economy isn't really what's driving the stock market. I think if we want to look at the stock market, we want to see more of that spending keep materializing. So what's interesting is looking at the price earnings multiples or the valuations of those AI companies, they're actually coming down because their earnings are growing faster now than their prices. So that's good because it's real earnings behind those companies. So at some point, AI has to convert into productivity savings for people using AI too. And so if we can do more with less people, or we can do more productivity with the same number of people, we can actually start to make companies more profitable all the way downstream as well.
Speaking about the equity market, in the 1950s, 60s, and also 70s, stock market rose. However, at the same time, unemployment was also very high. So do you think today's situation is kind of similar to those days, comparable, or is there any fundamental difference?
There are so many differences. I know a lot of people like to look at history, but you think about the 50s, 60s, and 70s, demographics, which we kind of just touched on, there was a lot of people having 3 and 4 kids. The growth rates of most of the world's economies was really strong because the population was growing. If you look around the world now, almost no continent is having enough babies to keep growing its population. So the only reason population keeps going up is because there's not enough births, but people are dying older and older. And so actually we're getting more old people, which we know have to be supported, and so there's going to be less workers. So there's actually a much slower, I guess, kind of natural rate of the economic sort of expansion now than back in the 50s and 60s. And because the workforce is shrinking, the unemployment rate doesn't need to go up as much because there's really not as many people coming into the workforce as there was in the 50s and the 60s and the 70s.
Okay, so at the same time, surveys has been showing that consumer confidence recently have been weakening, and also half of retail investors are turning bearish. However, Wall Street forecast is that S&P 500 is going to reach probably 7,000 by year end. How do you interpret the divergence between consumer sentiment, I mean like retail investor sentiment, and also the Wall Street forecast?
Yeah, I mean, I remember when we had COVID and everyone got their stimulus checks and we saw a huge burst of retail trading.
Yeah, and also inflation really high.
Inflation was separate, right? Because that was caused by the supply chain bottleneck problem. But the trading and the buying was kind of caused by consumers having all this extra money. They weren't going out on vacations. They weren't going out to restaurants. They got their stimulus checks and they bought stocks.
Right.
They've kept trading. You're right. The last couple of months, we've actually seen consumers turn kind of bearish on single stocks. That's happened in the past as well. They've stayed bullish on ETFs. So they're still net investing in the stock market, but looking at single stocks, they're starting to pick their spots. I think how you align that with consumer confidence is, like we talked about before, because the job market's weakening, the confidence is kind of, I think, wages have stopped growing as quickly. People have probably run out of all their COVID actual savings. We're starting to see an uptick in credit card defaults and car loan delinquencies. And so there's a little bit of a sign that maybe lower income, especially consumers, are starting to budget a bit more and under a little bit more stress. And so that might be feeding through into their retail trading. But why is the stock market still going up? It's because of earnings, it's because interest rates and valuations. And so professional investors kind of look at those sorts of things and they have a longer term view, I guess, and less affected by their wages. And so there's a lot of arguments why the market could get to 7,000, like you say, by the end of the year on the S&P, because interest rates coming down helps the valuations of stocks go up because companies will pay less interest, but also that's how you value companies, is do you discount the future earnings, and the earnings are going up. And so that's all good.
Yeah, and right now the most crowded trades are still long Magnificent Seven technology sector, long crypto, long gold, short US dollars. So do you think this crowding as a potential vulnerability for the market, or is it justified by current fundamentals?
I guess we'll know when it turns, right? I mean, you look at the AI trade, and like we said, the multiples, the actual price earnings multiples are coming down right now. So the earnings for that particular segment of trades definitely supporting the valuations that we had. When you look at what people are talking about the Mag 7, they're actually, I think, starting to put different stocks into it. And so we're sort of looking more at broader chip manufacturers, people involved in large language processing. Like there's a few extra companies getting grouped into that AI trade rather than just the Mag 7. But as with all things, like if the earnings don't keep up, then they have to keep up. The valuations will eventually potentially come down. So we will see if some of the other asset classes start to hit points where consumer resistance and trading resistance happens.